Institutional managers cannot mitigate risk by reacting to real-time price movements of thousands of individual equities simultaneously. The volume of variables is too vast. The solution is mathematical distillation. Financial engineers require a synthetic proxy to compress that market chaos into a single, highly readable metric. That metric is the stock index, and it serves as the foundation from which risk branches into two mechanisms: the linear structure of futures and the asymmetrical profile of options. Before applying either of those derivatives, we must understand how the underlying index calculates market behavior. We will deconstruct how an index is weighted, examine the cost of carry arbitrage that anchors futures pricing, and isolate the variables of time and volatility that dictate option premiums. Modern finance does not trade physical assets. It trades abstracted mathematical risk profiles. A stock index is a statistical portfolio designed to represent a specific market segment. It is an active instrument of measurement, not a passive benchmark. This table calculates the market capitalization of a basic 5-stock index. By multiplying total outstanding shares by the current spot price, we arrive at the market cap, which dictates that single stock's proportional influence, or weight, on the entire index. Most major global indices refine this with a free float methodology. Watch the outstanding shares column here, as a large portion of shares are subtracted from the total. Excluding locked-in shares, like government or promoter holdings, ensures the final weight recalculates to reflect actual market liquidity. Equal-weighted indices ignore market cap entirely, assigning the same percentage to every stock. But maintaining that exact parity requires constant, expensive buying and selling. By aggregating diverse equities into a single weighted average, the index uses the law of large numbers to neutralize company-specific shocks. This leaves behind a concentrated metric of systematic risk, the movement of the broader market. Once that systematic risk is established in the spot market, traders move to the derivative space to lock in future prices today. Unlike bilateral, custom over-the-counter forwards, futures are standardized contracts marked to market daily on an exchange. This is the cost of carry formula, which dictates exactly what a futures contract should cost. The theoretical future price equals the spot price, adjusted by the cost of financing the asset, minus expected dividends. Interest rates push the price up, dividends pull it down. This timeline chart maps the spot price against the traded futures price. The vertical gap between them on day one is known as the basis. As time passes, institutional algorithms execute cash and carry arbitrage, buying the underpriced asset and selling the overpriced one. That mechanical pressure forces the two lines to converge exactly at expiration. Because of that convergence, futures are strictly linear. A 1-point move in the index guarantees exactly a 1-point move in the contract's value. Futures provide symmetrical, highly leveraged exposure. Institutions can hedge massive portfolios without paying any upfront premium. Options completely break that linear profile. The rigid obligation of a futures contract is replaced by a right. To secure this asymmetrical right without an obligation, the buyer must pay an upfront premium to the seller. That option premium is composed of two mathematical variables, intrinsic value and time value. This long-call payoff chart maps the index value at expiration on the x-axis against the resulting profit or loss on the y-axis. Right where the line crosses into positive territory, we find the break-even point. That is the strike price plus the premium paid. The defining feature of an option is visible here. The buyer's downside is strictly capped at the premium paid. The upside extends indefinitely. This short-put payoff chart illustrates the inverse risk absorbed by the seller. The seller's maximum profit is capped at the premium collected, but they accept steep, theoretically unlimited downside risk. Options are categorized by their moneyness: in the money, at the money, or out of the money. Only an in-the-money option holds actual intrinsic value. The premium of an at-the-money or out-of-the-money option is built entirely on time value. That time value is governed by the Greeks, the sensitivity metrics that power the Black-Scholes pricing model. Theta measures the exact accelerating rate of time decay. It constantly erodes the buyer's premium as the contract moves closer to expiration. Vega measures price sensitivity to expected future volatility. It assigns a numerical value to the magnitude of potential price swings, completely independent of the market's actual direction. These instruments move beyond simple directional risk transfer. They allow sophisticated traders to isolate and exchange time and volatility as distinct, quantifiable assets. Institutional traders combine these basic derivative components to construct highly specific structural outcomes. The bull-call spread is a primary strategy used to cap risk and finance premiums simultaneously. We begin with this foundational move, purchasing a lower strike long call. Next, we add a modifier by selling a higher strike short call on the same underlying asset. The premium collected from the seller offsets the initial cost. When we mathematically combine the two positions, the lines merge into a single Z-shape payoff profile. The structure strictly caps the maximum possible loss, but it requires a mathematical trade-off, a hard cap on maximum profit. Beyond basic spreads, portfolio risk is managed through delta hedging. If a trader holds a short at-the-money call, they are exposed to a delta of minus 0.5. For every single point the index rises, the option value moves 50 cents against them. To achieve market neutrality, the trader buys exactly half a unit of the underlying asset. We see that here as taking a long futures position with a positive 0.5 delta. The directional risk perfectly offsets. Derivative composability allows financial engineers to isolate exact variables. They can profit solely from implied volatility changes, while remaining completely immunized against actual market direction. Zooming out from the granular math reveals the macro architecture of the entire derivatives ecosystem. The stock index is the mathematical bedrock, capturing macro market behavior as a single proxy. Futures act as highly liquid, linear levers used to symmetrically scale or hedge that systemic risk. Options function as nonlinear, multivariable scalpels, slicing risk according to strict parameters of time and volatility. These three tools interact continually. They provide the absolute liquidity and targeted risk transfer necessary for the global economy to function. Modern financial engineering is not about predicting the future. It is the science of mathematically reshaping the geometry of risk itself.